Welcome to the Explainer. I am so pumped you're here today because we are going to completely overhaul how you look at the markets. I've been in this game a long time, so consider today your orientation day. I'm taking you under my wing to show you the professional's absolute secret weapon, the COT Report. By the end of this Explainer, you're going to stop guessing and actually start trading with the heavyweights. All right, let's jump right in. I need you to be honest with yourself for a second. Why do you keep buying right at the exact top, only to watch the price instantly crash? And then, why do you panic sell the very second the market hits rock bottom? Look, I'm going to give you some tough love here. It's because you're trading blind. You're just following the crowd, and honestly, you're serving as liquidity for the pros. The market is literally designed to take your money if you don't know who you're sitting across the table from. But today, we fix that. Here is our exact game plan for today. We're going to cover 1. The 3 market players. 2. Getting the COT report. 3. Mapping 3-year extremes. 4. Waiting for the flush. And finally, 5. The exact entry plan. If you lock in and follow these exact steps, it's going to cure those bad trading habits for good.
Okay, Section 1, the 3 market players.
Before you place a single other trade, you have to know exactly who you're playing against. The market isn't just some random chaotic thing. It's a matrix, and it's driven by 3 very distinct groups. First up, we have the swap dealers. We call them the smart money. Think of your giant banks, Citi, JP Morgan, Goldman Sachs. They're mostly net short because they basically act as the house, providing liquidity to the market. The absolute crucial takeaway here is that they hold massive sway. They can cap a rally whenever they feel like it, and, well, they're usually right. We always want to know what the smart money is doing because they own the board.
Next, we've got managed money, or the hot money. This group is made up of your hedge funds, CTAs, and massive trend-following algorithms. They buy when prices are rising, and they sell when prices are falling. Honestly, they're the guys driving the current price action. But here's the secret. They chase those trends so incredibly hard that they end up being completely wrong at market extremes. When they push too far in one direction, that is exactly who we want to bet against.
And finally, we have the non-reportable category. Let's just call it what it really is, the dumb money. These are everyday retail traders, small speculators just trading on pure emotion. They buy tops, they sell bottoms, and they serve as the ultimate contrary indicator. I know it stings a bit to hear, but right now, if you're just starting out, you're in this category. Our entire goal today is to graduate you out of the dumb money so you stop trading with the herd.
Section 2, Getting the COT Report. Believe it or not, the government actually publishes a literal cheat sheet every single Friday that tells us exactly what these 3 players are doing in the futures markets. And since spot prices follow futures, this is basically your crystal ball. I want you to make this a strict, non-negotiable weekly ritual. Every Friday, follow these exact steps. Step 1, go to cftc.gov. Step 2, click Market Data. Step 3, click COT Reports. Step 4, choose the disaggregated report because it's way easier for beginners to read. And step 5, find your specific market, like Euro, FX, or gold. Bookmark that page. This is where you pull the raw data to see exactly who is buying and who is selling. Section 3, Mapping 3-year extremes. Okay, having the weekly data is awesome, but it's totally useless without context. We have to look back historically to figure out when a market is severely overcrowded. I want you to visualize a chart of the managed money net long positions over the last 3 years. Now, ignore the noise in the middle. We only care about the absolute edges, the 10% line. If hedge funds are in the top 10% of their 3-year range, danger zone. The trade is overcrowded and a drop is definitely coming. But if they're down in the bottom 10% of that historical range, that means the weak hands have been completely flushed out. The selling is completely exhausted. Let me show you what this actually sounds like in the real world. Managed money net long in gold has fallen to its lowest level since 2022. When you read a headline like that or spot that data point in your Friday report, alarm bells should be ringing in your head. That right there is a bottom 10% extreme. The hedge funds have given up. This is your flashing neon sign to wake up and start hunting for a massive buying opportunity. Section 4, Waiting for the flush. Now pay very close attention because this is the most critical lesson of this entire explainer. Spotting the extreme is not enough. You need extreme, unwavering patience. You cannot, I repeat, cannot just see that current extreme level and blindly hit buy. You will get crushed. we have to look at the week-over-week momentum change. The direction things are moving is often way more important than the actual level. We need to see momentum actively shifting. We need hard proof that hedge funds are leaving the market and the big banks are stepping in. Imagine you're looking at the data, and you see retail traders are 80% long on gold. A rookie looks at that and goes, "Oh, gold always goes up. Literally everyone is buying. I better get in." Wrong. A massive 80% majority means the retail market is deeply, dangerously crowded. Remember, the crowd is a contrary indicator, and they are almost always dead wrong at the top. So this is actually a screaming bearish signal. If you buy here, you are walking straight into a trap. So here is the crucial takeaway. Stay in cash until the COT data shows the flush is completely finished. Seriously, sit on your hands. Do not enter before the trigger. If you jump the gun and enter too early, you just become part of the weak hands that the smart money needs to shake out. The market will gladly take your money first before turning back up. Just wait for the hedge funds to get completely wiped out. Listen to this quote. This right here is the ultimate mindset of a successful professional. I waited for managed money to reach a 3-year low before buying. Then I bought near the bottom. Now contrast that with your typical rookie. I bought because it was going up, but then it crashed, right? Patience is the literal dividing line between smart money and dumb money. Let the data come to you. Section 5, the exact entry plan. All right, you spotted the extreme, you waited patiently, and now it is execution time. I'm going to show you exactly when to pull the trigger. Memorize this 2-week confirmation checklist. When you hit an extreme, wait for 2 consecutive weeks where all 3 of these things happen. First, managed money net long has to be decreasing. That means trend followers are selling. Second, swap dealer net short must be decreasing. This is huge. It means the giant banks are covering their shorts and buying back. Third, retail net long must be decreasing. The emotional small traders are finally giving up and taking losses. When you see that line up for 2 weeks straight, the flush is officially happening. So here is your final non-negotiable buy signal checklist. Number 1, managed money is down in that bottom 10% 3-year extreme. Number 2, banks and retail confirm the momentum shift for 2 straight weeks. Number 3, open interest is rising. That tells us new, real money is entering the market to support the move. When all of those align, step 4, buy at market price. And step 5, always practice strict risk management. Put your stop loss 2 to 3% below the recent swing low. Look, if the banks are still adding shorts or retail is still piling in, you stay out. Simple as that. Let's walk through how this actually plays out in real time. Imagine you're trading the euro. 3 months ago, managed money drops into the bottom 10% of its 3-year range. What do? Nothing. You don't buy. You wait. Then, 1 week ago, the numbers drop again. Banks start covering, retail starts leaving. Boom, that's your first week of confirmation. Then, this Friday, the new report drops. Second week confirmation is achieved. Open interest is up. Now, and literally only now, do you execute the trade. You let the market perfectly align before you ever risk a single dime. And that brings us to the ultimate question. Friday is coming. The government is about to release the next COT report. Are you going to keep trading blindly, running on pure emotion and hope? Or are you going to download the data, map out the extremes, wait patiently for the flush, and actually trade alongside the giant banks? Will you be the smart money or the dumb money? The choice is entirely up to you. Thanks so much for hanging out with me on this explainer, and I will see you in the markets.